So with that, Ellie Armstrong, please come on up with your panel to discuss target date discussion thought. It's an target funds, evolving landscape, and it's good to hear what the latest thought by the thought leaders is. So, Ellie?
Hello, everyone. How's everybody doing? Awesome. I talk a lot, so I honestly didn't prepare a big, long introduction, or else I just would have gone 10 minutes long, and we don't have time for that today. So let's just jump right in. I want to introduce our panelists, or have them introduce themselves, and the best icebreaker of all time, which apparently, as I've learned from last time, is what is your favorite concert? So, or the best concert you've ever been to. So let's do name, where you're from, your role in the firm, all that, and then best concert you've ever been to. Who wants to start? Let's go. Yep, Andrew.
I'll jump in. So Andrew Kuhn with Rowe Price. I'm one of the client portfolio managers covering our target date strategies. Been with Rowe for over 10 years now. The first concert I ever went to was Jimmy Buffett, and I think it's one of the only concerts where I saw 16, 18-year-olds puking next to 65-year-olds at the same show. But the best concert I've ever been to, and I've seen him over 15 times now, is Dave Matthews Band. I think one of the best live performances I've ever seen. So, yeah.
15 times.
Yeah.
Hello, everyone. Kyle Schmidt with BlackRock, based in Minneapolis, DC IO wholesaler with coverage in the Midwest. So I recognize a lot of familiar faces out here. In terms of best concert, there's lots to choose from, but I had a memorable one just last Thanksgiving. I found myself stuck in Indianapolis for my daughter's Irish dance recital, whatever you call it. And my 17-year-old son and I were looking for something to do, and it turned out Kiss was playing one of their last concerts a couple miles away. So we snagged last-second 10th row tickets for cheap and got to watch one of Kiss's last performances. And I was meant to see Kiss in concert, and it didn't disappoint. They're phenomenal. So that was.
You missed your daughter's recital for it, or you
I
made
did.
both?
I missed the recital.
Okay, yeah. That's good. Priorities.
Priorities, exactly.
Gee, I promise we didn't talk about this before we walked in. So my first concert would have been Kiss in the 80s.
There you
so
go.
On the other end of it, young and stupid versus old and stupid. And then most recently would have been the Dropkick Murphys at Fenway Park. So Mark Ferraro, Capital Group. I'm based here in Chicago, and DCIO and record-keeping sales.
Awesome. Mine is the Eras Tour in LA. Does anyone here like Taylor Swift? Come on. Yes. Her new album just came out, people. This is so exciting. I had the best weekend ever. All right, well, thanks so much, guys. We're gonna be talking about everything target date fund, so let's just jump in and start with glide paths. So Kyle, can you please explain your firm's glide path objective and if there's more than one glide path offering?
Yeah, absolutely. So we do manage target date funds all over the world. We're in 9 countries, and so every glide path is going to be a little bit different based on the demographics, savings rates, things like that. But in the U.S., which I think is probably what most everybody here cares about, really our philosophy is based on what we call GPS, grow, protect, spend. So our view is you should really maximize. A little chatter back there. You should maximize growth assets early in the glide path. We think participants, when they're young, can take all the risk in the world. What's really driving their account balances are their payroll contributions. It's not market gains and losses, so they can handle the volatility. So we start at 99% equity. Frankly, we'd be at 100, but to qualify as a QDIA, we have to have 1% in fixed income. And then, so that's the G part. The P is protect. So we want to really focus on protecting capital for those folks that are nearing retirement. When the balances are larger, the sensitivity to losses are a little bit greater. The glide path's going to sort of come down a little bit quicker maybe than some of the peers, because really we want to try to protect those folks from making the wrong decision at the wrong time. And then spend. Ultimately, in retirement, we want to really allow people to have the same ability to spend as they did throughout their earning career. So we land at 40% equity, and we hold it there constant. That's not, so we may get into the 2 versus through, but we view it from beginning to end. We just have made the decision to keep that allocation static at retirement and into retirement at 40-60. So that's kind of at a high level how we think about our glide path.
Great, thank you. I'm curious to hear from Mark about American Fund's approach. So we know that target date fund glide paths vary widely across the target date fund landscape. So what is American Fund's differentiator?
Sure. So the objective is to build wealth and preserve wealth. And the way we do that is through the allocation of equities and fixed income throughout the glide path, early on in the glide path, we'll have a higher weighting towards growth type equities, and then as the participant moves towards transition and then into distribution, we'll shift to a more dividend paying strategy, keeping them at a higher maybe equity weighting, but with lower volatility securities. And we found that that served us well. Over the last 2 years, we've seen the glide path do what it's intended to do. In a high growth market, you'll get top decile results out of the front end of the glide path, and then as you get the reversion to the dividend side, you'll pick up that high quartile ranking later on in life. So the other thing we do that might be a little unique is we use our balanced strategies inside the glide path through the entire stretch of the 45-year work career. What does that mean? American Balanced Fund, Global Balanced, and Capital Income Builder. These are funds you might be familiar with. They have a weighting throughout the glide path, and what that does for us is during market cycles, it lets the underlying managers in those strategies be a little bit more tactical based on what the market's giving them at the time. So we get that appreciation throughout the length of the glide path.
Awesome, thank you. So Andrew, T. Rowe, where does T. Rowe's glide path fit in all this?
Yeah, so I think we're a bit unique in the industry in that we offer multiple glide paths, because I think, like many of you out there, we recognize that not one glide path is going to be suitable for every plan out there, right? Plan demographics are going to be different. The objectives that the plan wants is going to be different. But I'd say that our overarching goal is for two things. We want participants to eat well, and we want them to sleep well. Right? The eat well is that we want them to be able to sustain the same standard of living on day one of retirement and year 30, year 40, however long their retirement's going to be. And to put some math behind that, if you just have 2% inflation over a 30-year retirement, day one, if you need 100,000, just to make the math easy on myself, year 30, you need over 180,000. Right? So we think about it in real dollars, not just nominal dollars. People want to be able to keep the same standard of living, and that's the eat well. And the sleep well is not running out of money in retirement. I think we'll probably get into this a little bit later, but we just continue to see individuals are not saving enough to be able to fund the liability of spending in retirement. So our goal with both of our glide paths that we offer is to help them eat well and sleep well. And again, that sleep well is not running out of money in retirement and really trying to mitigate that longevity risk.
Awesome, great. So we've got 3 different perspectives. I just wanted to kind of lay them all out and have a foundation before we get into the weeds a little bit. So switching gears, from time to time, managers will make adjustments to the glide path or underlying building blocks for a target date fund series. So let's talk about some recent changes. Andrew, back to you. Have there been any changes to your glide path recently, and why?
Yeah.
What drove those?
So we've been managing target dates for over 20 years now. So we launched our first commingled back in 2002, and we actually had a custom client that we launched back in the mid-90s. So we've had a lot of experience managing target date strategies, and I'm providing that background to say we've only made one change to our glide path in the over 20 years that we've been managing our commingled target date solution, and this was back in 2020. And there were really 4 reasons why we did that. Plan sponsors are telling us they want to concentrate on longevity risk. Participants stay the course even during periods of market volatility. We improved our modeling, and we continue to see that people are under saving. So taking those one by one. So longevity risk, when we poll plan sponsors and ask them, why are you offering our target date fund for your participants? The number one answer that we get is longevity risk. If you look back 10, 15 years ago, it was market risk. Right? So we see that the evolution of plan sponsors and the risk that they want to mitigate has evolved over the last 10 to 15 years, where they are really focusing on that longevity risk and really helping their participants not run out of money in retirement. The second, and we talk about this for a lot of our paternalistic plan sponsor clients, people stay invested in target date funds even during periods of market volatility. Right? I think the main concern that we hear from plan sponsors is, well, if you take, if you're the aggressive target date provider, like we get painted with sometimes, what about those participants that get out at the wrong time, right? And we have a record-keeping database over 2 million participants, and we see, on average, only 0.6% of individuals make an allocation change in any given quarter, right? That number actually doesn't materially spike higher even during periods of market volatility. March of 2020, we only saw 1.4% of people make an allocation change, right? So the vast majority of people are saving for the long term and they're staying invested, meaning they'll be able to take advantage of our design over the long run. Modeling, I won't get into the details. We basically improved the way in which we take the inputs and gave us more confidence in the outputs that we were receiving. And then the fourth, and I mentioned this at the beginning, is that people are under-saving, right? This is both a savings problem that we're trying to help people with, but we believe that our glide path should be able to help make up for any shortfall risk in individuals under-saving to be able to meet their liability of retirement income.
Great, thank you. So I also know that T. Rowe wasn't the only firm to make changes recently. So Mark, earlier Capital Group made some changes to their glide path. Can you explain those a little bit?
Yeah, we're actually in the middle of a shift as we speak. It's expected to last throughout the year and be completed by the end of this year. Our capital market assumptions have a 20-year forward-looking assumption, and we're actually seeing there's an expectation that emerging markets will carry a heavier weighting as the markets recover. And that, along with some persona research, we used Eugene Hahn to do some research for us there on how participants are saving for and spending in retirement, and their behavioral characteristics are telling us that we need more, call it octane, early in the glide path. Number one, because salaries aren't keeping up with expectations. So the folks in that 25 to age 40 range are not getting the salary increases that the assumptions were calling for. So we have to make up for that a little bit differently, and we'll do that on the front end of the glide path. What that means is, overall, there's no change to the overall equity versus fixed weighting, so there's no prospectus change there. But there is some weightings changes where New World Fund and the Emerging Market Bond Fund will take on a little bit more of a weighting, which will result in a little bit of a decrease from the Capital World Growth and Income Fund and the Global Balanced Fund. Ultimately, it's about a 1% to 2% change for New World Fund. So if you looked at the underlying holdings, you'll see that where these changes are taking place. We're working through it now, and we should have it all set up by the end of the year.
Great. So I want to keep the conversation going about recent changes, but let's shift it to underlying funds specifically. We know that a target date fund is only as strong as what's under the hood. So back to Andrew again. Could you speak on T. Rowe Price's underlying structure and recent changes with that a little bit more?
Yeah, absolutely. So kind of as I mentioned with a glide path, we've only made one enhancement, but we think that's really designed for the long term, right? This is a 70-year problem that we're trying to solve for. So we feel really comfortable with the glide path that we have in place now. But when we think about diversification, we tend to make underlying enhancements to our diversification every 2 to 3 years. And the most recent example the most recent enhancement that we made last year was to add 2 new underlying building blocks, one in equity and one in fixed income. And both of them have the exact same goal of helping to provide some downside risk mitigation while still participating on the majority of the upside. So rather than just reducing the equity, because of what we saw with the correlations between bonds and stocks kind of dislocate in 2022, right? Just de-risking into bonds didn't work. And while we still think that bonds are going to provide a good risk mitigation tool for our glide path and for our investors, we think that there's better ways to be able to reduce risk within the portfolios while still focusing on that longevity risk and growing the balances enough for individuals to be able to eat well and sleep well. And I think the really positive thing about target date portfolios is that individuals can get institutional level diversification, institutional pricing in a portfolio that is easy for them to understand, right? It's retail friendly. And that's ultimately really what we're trying to strive for, is that institutional kind of DB type of diversification that can be in an easy to consume, easy to understand wrapper for the end participant.
Awesome, thank you. Kyle, staying on the topic of underlying funds, does BlackRock use active or passive building blocks in your solutions, and why?
We use both. So everything at BlackRock starts from a target date funds perspective with the LifePath Index. So LifePath Index is going to use a passive approach, but we always say there's no such thing as a passive target date fund. You have to choose the glide path and you have to choose the underlying building blocks. So most recently we did make some changes, and we're constantly, I'd say every few years, looking for ways to improve and enhance what we're doing with the underlying building blocks. So we did break apart the fixed income exposures. We thought we could be a little bit more precise. Historically, we've used the Barclays Ag as all of the fixed income exposure, and that's what everything's been benchmarked against. We've got reasons for why we don't include high yield international bonds that I won't bore you with. But we did some research and found that we could be a little bit more precise by breaking out the ag to its underlying components and then reallocating to those across the glide path, so such that long credit is going to get more of a weighting when folks can take more risk, and long treasuries is going to get a little bit more of a weighting when folks are de-risking and need that ballast to equities. So that's sort of the baseline that we use as the LifePath index. And then LifePath Dynamic is our active expression. So really there we're taking a much more intentional approach in terms of what active strategies we use across the glide path, with using LifePath Index as the benchmark. So really the only investable benchmark that we see across the active target date fund landscape. And I'd say there is LifePath Dynamics an area where we've been looking to constantly improve upon what we're doing and just looking to become more customized in terms of the underlying building blocks that we're using, as opposed to just simply using sort of the greatest hits from BlackRock in terms of a mutual fund perspective. We're really trying to be very customized, deliberate, intentional about how we're building those exposures to then allow our tactical asset allocation team to express their views over the top of that. And so that's tended to work very well with pretty strong outperformance across the index series.
Great, thanks. Speaking of tactical asset allocation, Andrew, could you go into T. Rowe Price's view on that a little bit?
Yeah, absolutely. So, I mentioned that, this is a 70-year problem that we're trying to solve for, and we spend a lot of time, energy, and research on making sure that our glide path is designed for the long run, and same with diversification. But I think we also recognize markets don't just move up in a straight line, and so we have a process in which we can tactically overweight and underweight asset classes. And I'd say a key differentiator for us relative to other asset managers is that this is a proven process that we've had in place for over 30 years. And this is not done in isolation just at the target date level, nor do we kind of outsource it to underlying portfolio managers. We take kind of a top-down view. We have an asset allocation committee that meets on a monthly basis, and sometimes more often during COVID, they were meeting on a daily basis to talk about how do we want to position the portfolios. And it's those types of COVID-type sell-offs that we're really looking to take advantage of from a tactical perspective. This is not meant to be the primary driver of returns. It's really meant to incrementally improve returns and also for us to be able to reduce risk. I think most importantly, when we think that valuations have gotten extended over certain asset classes. So it's a way for us to be able to reduce risk, to be able to add returns. And the third is those modest and tactical shifts. So we have guardrails in place at the glide path level. We can only go plus or minus 5%. Back in COVID, we were about 3.5% overweight equities. As equities were selling off, we were buying into the dip. To give you a sense of kind of that's the type of market sell-off that we would need to see to kind of even start to approach those limits for our tactical shifts.
Awesome, thank you. So now that we've discussed recent changes, let's switch gears again and explore alternative implementations and custom offerings in the target date fund space. So Mark, Capital Group has partnered with firms launching co-manufactured target date funds. What's available, and can you give us some insight on the differences between the co-manufactured versus your flagship series?
Sure. So you'll hear us use the terminology co-manufactured, and that's where we've been asked by some of the record keepers to build with them a target date solution that offers opportunity for maybe sleeving in a stable value or a fixed account for the glide path to help. I mean, as we know, these record keepers are all in a race to the bottom, and as a result of that, this gives them the ability to maintain a portion of the asset management in the latter end of the glide path. We currently have 10.
Oh, sorry, I don't know what's going on over there. Is this?
I'm usually loud enough without it. We currently have 10 strategies in the market today, 2 of them through FlexPath. We're excited about that. It allows us to work closely with our record-keeping partners and help them build their programs, and for us, obviously, as an asset manager. All right. Oh, wow. There we go. Test. All right. So what you get with the co-manufactured solution generally is a more conservative target date solution. So just simply by sleeving in the stable value, you're going to stabilize the fixed income portion of the glide path in a way beyond our traditional use of fixed income funds. There's also a potential for record keeping credit. You'll find that a lot of these clients need that credit, and this gives them an opportunity to bring that in and reduce overall plan costs. And then in some cases, it results in a little bit lower of an expense ratio because of the fixed account. So it's worked real well for us. There's lots of different ways to buy our expertise. Think of us as the equity side manager with giving up a little bit on the fixed income side to the record keepers.
Awesome, thank you. Kyle, Can you elaborate on how your firm's custom FlexPath offerings differ from your flagship series, your BlackRock LifePath Index?
Yeah, no, absolutely. So if we go back to 2014, that's the last time we made any meaningful changes to our glide path, and that's where we increased that long-dated vintage exposure up to 99%, and we increased the retirement exposure up a little bit as well, landing at 40%. And again, I think to Andrew's point earlier, that's because we just saw that people weren't saving enough. It wasn't so much based on capital markets expectations, it's just we recognized we needed to help people. If they weren't willing to save, we were going to try to help them earn their way to a better retirement. At that same time, we also recognize that there's some clients that 40% landing point wasn't appropriate for them. Maybe they wanted to be a little bit more aggressive. Maybe they wanted to be a little bit more conservative. So that's where in our CIT vehicle, we launched an aggressive version of LifePath and a conservative version of LifePath with the landing points at 50% and 30% respectively. If that all sounds somewhat familiar, that's because that's what became the glide paths for FlexPath in 2015. So really that's outside of all the differences that Mark touched on in terms of there being a stable value component with some of those custom implementations, it's really the three glide paths are the largest change there. In terms of custom, we do a lot of custom business for kind of mega billion-dollar plans. That's really based on their specific demographics. But what I will tell you is what we have found is that you have to have some pretty unique demographics to really justify a completely customized glide path and implementation. So we've done a lot of analyses for a lot of very large corporations, and ultimately we find that a standard glide path is generally going to be pretty appropriate for most of them.
Great, thank you. So thanks everyone for sticking with us so far. We're sort of wrapping it up now. We still have got some time, but I want to talk about managing inflation concerns and future trends. So Andrew, given concerns around inflation, how does T. Rowe Price manage for that?
Yeah, so I think we view the inflation problem kind of solving it through three different lenses: long-term, medium-term, and short-term. So the first, the long-term, the glide path, equities do a phenomenal job of hedging against your inflation risk over long periods of time, right? If you just look at the real rate of return for equities over 5, 10, 15 years, in most scenarios, it's going to be positive, right? So it's generating a positive real return after inflation has been taken into consideration. So that's the first thing. I think when we think about our glide path, it's not just nominal returns. We want real returns because, like what I said earlier with Eat Well, Sleep Well, we want them to be able to keep the same purchasing power throughout their retirement. So we really focus on mitigating that inflation risk using the glide path for the long term. Over the medium term, think 5, 10, 15 years, we have dedicated asset classes that should do really well in an inflationary environment. So we have a dedicated real assets equity sleeve. So this is a diversified portfolio of global natural resources companies, think energy companies. It also has real estate in it, both here in the US and global, and also has metals and mining companies as well. These companies and these equities tend to do a really good job of hedging your direct inflation beta during a rising and a high inflationary environment. So the beta to inflation is very, very high. So you get a really good kicker in the portfolio when inflation rears its ugly head. We also, on the fixed income side, have an allocation to tips, right? And we focus on the shorter duration aspect of tips. And I think that is kind of a differentiator between us and other asset managers out there, because when we look at adding tips to the portfolio, we want them to do well in an inflationary environment. What also happens in an inflationary environment, the Federal Reserve is raising interest rates, right? So at the exact time you need tips to work, you also don't want to be taking too much duration and interest rate risk within that portion of the portfolio. So we focus on the 1 to 5 year kind of index for the tips. So that's the medium term, right? We have tips and real assets equities. And then on a shorter term, I talked about tactical earlier. So we can tactically overweight and underweight to different asset classes based on our views of the inflation outlook and which of our asset classes we think are going to provide the most amount of protection based on our outlook. So currently, we're overweight real assets, we're overweight tips. We think that the risk for inflation is to the upside, not the downside. And I think the real wild card, I know we have a capital markets presentation coming up, but for our view, we think that energy is kind of the wild card right now. Right, with the geopolitical tensions out there in the world, we see supply coming down. We think that cost curves have basically gone as low as they can with a lot of the fracking that's been done We don't think that their cost curve innovation is going to be able to reduce cost curves, so supply is going to stay low. At the same time, GDP growth has actually still been quite robust, both here in the US and across the globe. So demand for energy and demand for oil has also been higher. So tying all three of those things together, we think the risk for energy, especially oil and nat gas prices, is to the upside. So our view is that maybe one cut this year, but the risk is for less, not more, and the risk is also for potential hikes this year if energy does rear its ugly head and you start to see a material spike in inflation. So again, to wrap up, long-term, glide path does a great job. Over the medium term, you want to have diversified asset classes like real assets and tips. And then over the shorter term, we have the tactical overlay to be able to overweight and underweight based on our outlook on inflation.
Great, thank you. Speaking of long-term, I want to hear Mark on long-term results. So the American funds, target date funds, continue to have strong long-term investment results in 2023. Longer dated vintages landed in the top quartile, while near dated vintages in the bottom third of peers. Can you go into that a bit and explain why?
Yeah, sure. So the last 24 months have been interesting, and it's really put a test on the series. There's really three things that have driven the last 24 months for us. One is a wide dispersion. So you've had this dispersion between growth and income. You've got concentration in the equity markets, the Mag 7, we all know the story there. And then, our focus on high quality fixed income, those have been the headwinds for the series. The result was the longer dated vintages did really well, and the shorter dated vintages had a little bit of wind in their face. And that's something you're going to expect to see. If you look at our heat maps, and I'm sure you've seen some of this, you'll see that year over year. So if you go back to 2022, we had the exact opposite issue where folks nearing and in retirement had third quartile results at that time, while the top, the younger folks had top quartile results, and then we've seen that revert back with the way the market's changed. So those are the things, we're talking about it in like the tale of two cities. It is exactly what's supposed to happen with the way we manage the glide path. We're selling out of these growth type equities, buying into more dividend positions as the employee is starting to draw on that, and that's where we're going to achieve our alpha through the use of dividends. It lets us hold that longer equity position, although the equities aren't the same as they were 30 years ago. So, but that's what it's been for us if you look at the heat map.
Great, thank you. So this last question is for Kyle, but I just now decided that that I want Andrew and Mark to also answer this. So what do you think the next big thing is in the target date fund space?
That was for me? Sorry.
That's for you,
okay.
Kyle. And then we're going to go around.
Well, I think the buzzword right now, if anybody here attended the NAPA conference in Nashville a couple of weeks ago, it's income. It's finding a way to incorporate retirement income or some sort of guaranteed solution into the target date fund, because we recognize the target date fund is certainly the vehicle of choice, I think, across the DC landscape. And so everybody's looking to incorporate income, and we're no different. So LifePath Paycheck officially launched on Friday. And so we are incorporating a liquid guaranteed option into the glide path. And I think really everybody out there is talking about this, right? So I think retirement income is probably the next big thing. I think maybe you touched on it briefly earlier, Ellie. Alternative assets, I think, too. Everyone wants to incorporate private equity, maybe some hedge fund strategies, those types of things. It's just trying to reconcile the liquidity mismatch that you get with those types of funds. So I think that's something that there's a lot of work being done internally at BlackRock, and I'm sure across the industry as well. And so that would be a potential next iteration. But I feel like income is really the hot topic right now.
Mark, you're up. What's the next big thing? What do you think?
I mean, I think we're all trying to figure out the retirement income portion of this, right? Do the target date funds have the ability to sustain a withdrawal over a long period of time, right? I mean, a 65-year-old is still a long-term investor in our eyes. They need that money to last, cradle to grave, so another 30 years. We probably won't launch our own retirement income series. We're working with a couple of the insurance companies now to deliver a product through their record-keeping systems that will address that. We have retirement income funds that we've been using, but that's really the big thing that we're looking at now is how do we solve for folks that are looking for a paycheck beyond what the target date will throw off.
Absolutely. Andrew, last but certainly not least.
Be a broken record and say retirement income. Look, we've been talking about retirement income for 20 years as an industry, right? We strongly feel, and why we're all talking about it, and why it was at NAPA and a lot of other conferences, is we see data that tells us that people are staying in plan longer than they ever have, right? And we're also seeing adoption. So we have a retirement income solution that pairs with our target date portfolios, and we have over 60 plans that have adopted this, that have 50 billion in assets within the plan. And so the adoption has been really strong, and clients really want a solution for those individuals that are staying in plan post-retirement. And we think that there's economies of scale on both sides. Right, on the participant, they get a built-in fiduciary, they get institutional level pricing, and for a lot of individuals, they don't necessarily need all of the different investment options that you would need. There's always going to be need for advisors, for high net worth individuals that have more complicated financial pictures. But for a lot of individuals where maybe all or most of their net worth is just in a 401k, they're looking for simplicity. They're looking for an easy, affordable option to be able to help them draw down assets. And I think the other key takeaway from both our analysis and talking to plan sponsors and advisors like yourselves is that there's not going to be a silver bullet for this solution. I think we all know that. We know that there's not going to be one specific type of retirement income solution. So we think multiple products are going to be needed, but you also need to think about this from the education side, right? We know that education, financial wellness is critically important in the retirement savings goal, but we think it's going to be really critically important for the retirement income goal as well, because individuals will need help in understanding the multiple solutions that they have in their plan and which of those are going to be most suitable for them based on their unique needs and circumstances. So I think, as Mark and Kyle both talked about, this is going to be both a short term, but you're going to be hearing about, especially from T. Rowe Price and probably others, over the next 5, 10, 15 years. This is going to be a multiple decade problem that we're going to be trying to solve here.
Great. Thank you. Well, to my surprise, we have a few minutes to spare. I did not expect that to happen. I don't think I've ever finished early. But let's open up to questions. I know that we can pass around the mic if there are any questions.
Yes, I think I'll repeat the question and give me a head nod if I got it. But how do we think about plans that are changing target dates for their participants? So switching from one target date provider to another. Participants changing jobs. Okay. I can.
Go ahead.
I think, we know that individuals, unlike, 30, 40 years ago, they're much more mobile, right? They're going to be changing jobs more often. But the way that we think about it is the end goal is not changing, right? The end goal for that participant, whether they stay in one job for their entire career or whether they're bouncing around, does not change the fact that they are putting this money away for retirement. So that end objective of what I think we're all trying to solve for is not changing. And there are going to be lifetime employees. So even though most people in a plan are going to be bouncing around jobs every 2, 5, 10 years, there are going to be some lifetime employees. So plan sponsors, I think, need to think about what is the target date that's going to be most appropriate for the demographics that I have for the plan population as it stands today and where I think that's going to be. And also think about the fact that this is a long-term problem that they are trying to solve and that we are also trying to solve. So short answer is the problem is not changing whether you're changing jobs frequently or staying at one employer for your lifetime. The goal doesn't change, and therefore we don't think that it really should matter all that much whether they're moving in and out of different employers.
I would maybe just add real quick that, this sort of tees up a nice little plug for the FlexPath strategies, right? I think having 3 different glide paths, when you've got changing demographics, you've got people jumping back and forth, is really attractive attribute. And so I think that's something that helps mitigate some of the uncertainty of a demographic changing over time.
I would just say the simplicity of the name of the target date fund. That individual that changes jobs, if they're in the 2035 fund, wherever they land, they're likely going to have a target date offering. It's pretty simple to say, gee, I need to be back in the 2035 fund. And I think as you look at all the manufacturers of the target dates, we all use a lot of the same persona data to get us to income replacement. And it's hard to really differentiate equity fixed weightings, looking beyond the name of the fund. So I think folks moving because of the simplicity are more inclined to simply I'm going to take the 2035 fund at my next employer. So I think that helps.
Great question. Thank you, guys. Any others? You probably have time for one more. No? Okay. Oh, I'm sorry. I can't see very well. Yes, I see you.
I I guess, real-life applicability question. For when you're getting feedback from the employers, so the presentation has happened, whether it's you directly or the advisor, what's the most feedback you get, or what topic? Is it pricing of the target date fund? Is it performance? What do you hear really when they're making a buying decision is the most important from the employer's perspective?
Yes. It's pricing and performance are the two top things that we hear. There are obviously other factors, and that's where we love to be able to interact with you all prior to finals or due diligence meetings with your clients so that we can understand what's going to be most important for them, because the more that we know about the client, the more we can customize, maybe not the specific presentation the way that it looks, but our talk track, right? And making sure that we talk to them about things that are important, because some plans are going to say performance is going to be most important, others are going to say price, others are going to say glide path, diversification. But if I were to say the two things that bubble up most in finals presentations and due diligence meetings that I have with plan sponsors, it's going to be price and performance, with a glide path being kind of that close third.
Yeah, I guess I would just add that certainly where we've had the most success, obviously on the index side, a lot of it does come down to cost. But where we've really seen the most success is when people really buy into our glide path philosophy. And on the active side, they buy into the way that we manage the portfolios in terms of having a tactical asset allocation overlay and being very intentional about how we use the underlying building blocks. So while it does often come down to cost and performance, we certainly would like to have more in-depth conversations about all the things that we think matter. And I think ultimately do differentiate the three of us up here and our offerings. So we'd implore all of you, to the extent that you can, let's have those discussions, because I think it's a lot more meaningful and it provides a better relationship ultimately with your end client.
Yeah, I would just add outcomes to that, right? So it's one thing to be low cost and have great results, but it's all about, spending outcomes, right? They can't spend performance and retirement. So we spend a fair amount of time in a sales interaction taking it from, hey, here's how we got here, here's all the numbers. They kind of gloss over in that, but when you turn it around and show them dollars and cents of, what would the individual have had over this long haul, it's, how much money do they have to spend in retirement? So focusing on participant outcomes might be something that you want to make sure you make part of your delivery.
Well, thank you all so much for the questions. Let's give a round of applause for our panelists. We're going to be here for the next 2 days, so feel free to come up to us and keep the discussions going. Thanks so much, everyone.